What is the back-end ratio? The back-end ratio, also known as the debt-to-income ratio, measures the portion of a borrower's monthly income used to service debt. This ratio is critical for lenders, such as mortgage issuers and bondholders, in determining a borrower's ability to repay loans and assessing their risk level. A higher back-end ratio indicates that a large part of the borrower's income is tied up in debt payments, signaling higher risk, while a lower ratio indicates less risk. Typically, a back-end ratio should not exceed 36%, although exceptions are made for borrowers with strong credit, where a ratio of up to 50% might be acceptable. Lenders often use the back-end ratio in conjunction with the front-end ratio, which focuses on housing-related payments. The back-end ratio specifically examines all debt obligations, including mortgages, insurance, credit cards, and other loans, in relation to a borrower's gross monthly income. The formula for calculating the back-end ratio involves adding up all monthly debt payments and dividing the total by the borrower's gross monthly income, then multiplying the result by 100 to express it as a percentage. Improving the back-end ratio can be achieved by reducing debt, such as selling assets like financed vehicles or paying off credit cards. Refinancing, particularly through cash-out refinancing, can also help reduce the ratio. However, refinancing generally carries higher interest rates due to the increased risk to lenders. While the back-end ratio is an important metric for lenders, it is not the sole determinant of creditworthiness. Lenders also consider a borrower's credit history and score. The back-end ratio does not account for the variability in interest rates across different types of debt, such as student loans versus credit card debt. Additionally, changes in interest rates or monthly payments do not immediately affect the ratio since it only considers the sum of debts. The front-end ratio, also called the mortgage-to-income ratio, focuses on a borrower's housing expenses in relation to their income, whereas the back-end ratio accounts for all debt obligations. Lenders commonly apply the 28-36 rule, which suggests that no more than 28% of a household's income should go toward housing expenses, and no more than 36% should be allocated to total debt, including credit cards and loans. This rule helps lenders and borrowers gauge debt affordability and credit risk.